Well, as I said, we've seen the Kenya Bureau of Statistics release its second quarter GDP estimate, which indicates growth of 4.1%. That compares to the 4.6% recording in the corresponding period last year. Your overall reading of the dip back that's come through in economic growth?
Well, Alishia, nice to be back. Yeah, I think it's not bad considering we are, after all, in the midst of a global crisis here. I'd say that 4.1% is not bad. It's still only, of course, 50% of what we project with Vision 2030. But we'll take what we can get.
Take what you can get, and obviously there's some sectors that have come to the party this time round. If we look at the positives on a sector basis, what's interesting is that despite the less than usual rainfall in most parts of the country, agriculture and forestry realized a significant growth of 5.2% for the second quarter compared to growth of 3% in 2010. To what extent has that come as a surprise to you?
Well, it's, not being an agronomist, I'm not exactly sure where those benefits came from. I mean, a little bit more rain would have done a great deal more. I do know that we've done well in the ICT, the information communication technology sector. We've done well in tourism and a couple of other sectors. But agriculture is extremely important in Kenya. We've got probably 60% of the population engaged in agriculture in some way or another. We can do a lot more, though. We can do a lot more in agriculture.
Of course, when it comes to some of the support factors, one would assume a weaker shilling would have come to bear, of course, with that sector being largely export-based.
Yeah, a weaker shilling is a double-edged sword. As you may know, I understand we've got the second worst performing currency in the world today. The stock market is also down about 25% this year. So, a weaker shilling is putting, there's a momentum in place now, of course, to make imports cheaper. And, but the thing is, with a weaker shilling, the way it is now, we've gone from about 90 shillings to the dollar to 100 shillings to the dollar in the space of 6 weeks. That's a little too fast. But I guess you could say we're taking a look at monetary policy, fiscal policy, trade policy, all at the same time. Oh. The Prime Minister has just announced the formation of a new committee to look at this in total, and I think that's what we need to do. We need to break the psychology of inflation here, and I think we need more than just monetary policy to do that.
Monetary policy, though, has come under severe scrutiny, as has the Central Bank of Kenya itself. So what have you made of the kind of rhetoric that's come through to the fore in that regard, and what the Central Bank should be doing from here on out to mitigate against some of the risks that a weaker shilling does pose?
Well, as I say, there is a global crisis. There's a rush to safety right now. Even other great emerging markets, you're seeing their markets fall off as people rush into the dollar looking for safety. Once we get past this Greek crisis, I think things will start looking up, and we can do a bit more. In our case, 25% of the blame I would lay at the feet of the international monetary crisis, but the other 75% is probably our own fault. I think we started too late tightening credit here. Mm-hmm. When we saw inflation, we should have nipped it in the bud. But now it's gotten a bit out of hand, I must say. Inflation is at 17% plus this in September, and now we're having to take a look at a broader scope here, where we're looking at fiscal policy. We need to be a little bit more responsible in our fiscal policy. We need to probably talk about balancing the budget over the next 3-4 years. In terms of trade policy, we need to start looking at some import substitution, possibly in the energy sector. Mm-hmm. We need to develop our geothermal electricity better. We need to look at agriculture. We need to do more value added in our agriculture. there's a lot of things we can do. And also, you know, we do have a growth plan here in Kenya. We have this Vision 2030. But we need to do more than just talk about it. We need more than just slide projections. We need to start implementing that with real solid business, pro-business policies. And so I think we'll get through this. It's not a good period for us right now, but I would say in another 12, 18 months, we're going to be back on track.
Until that holistic approach emerges to dealing with the economy that you've highlighted, James, we've got the MPC kicking off with its meeting next week. We're anticipating some kind of announcement in terms of monetary policy specifically. And I know you've stressed the importance of diverting attention away from just a reliance on monetary policy. But what are your broad expectations out of that meeting next week?
That meeting is in, you mean the meeting in Europe that's being called in Europe?
No, in Kenya itself.
Oh, that. Well, yeah, I mean, as I say, this is a good move. I think it's admitting that monetary policy is not sufficient, and we're going to be bringing all the government agencies. I would suggest, though, and I'm not exactly sure of who's attending, but we certainly do need private sector attendance at that in a big way. Mm-hmm.